Good afternoon, everyone. I am Michael Steelman, Director of Alumni Career Management and Professional Networks at William & Mary, and I'm delighted to welcome you to this afternoon's webinar, Coronavirus Impact to the U.S. Economy and Capital Markets. Today's webinar is part of the William & Mary Alumni Webinar Series and is made possible by the support of the William & Mary Alumni Association. Today's presentation is being recorded, and we will notify all registrants once the recording is available online with all previous webinars. Also, questions are welcome, and our presenters will answer as many questions as time will allow. If you roll over the bottom portion of the Zoom window, you should see a Q&A icon appear. Please use that feature to submit your questions. Throughout the webinar, I will monitor the questions and share them with our presenters at the end of their presentation. Now, without further ado, I'd like to invite my colleague and William & Mary alumna, Elizabeth Crafford, to introduce our guest presenters this afternoon. Thank you, Elizabeth.
Good afternoon, everyone. My name is Elizabeth Crafford. I'm the graduate of the class of 2015. I'm the Senior Assistant Director of Regional Engagement and Professional Network Initiatives based out of our regional office in New York City. Without further ado, I would like to introduce our panelists. First, Glenn Crafford, who happens to be my father and current COVID-19 housemate, is a proud graduate of the class of 77 and a parent of 2015, 2017, and soon to be 2020. Glenn had worked as an investment banker from 1982 to 2009, specializing in merger and acquisitions advisory services to international companies and private equity firms. He is currently of counsel to a New York-based boutique advisory firm specializing in corporate restructuring and is an adjunct professor at the Mason School of Business. Niles Chura, proud graduate of class of 91, maintains 25 years experience in distressed investing with major credit-based hedge fund. He writes and comments on economic issues, including U.S. fiscal and monetary policy, and is a frequent guest lecturer at leading business schools. Mike Cummings, proud graduate of 1993, has 25 years in investment banking experience focusing on equity and debt capital markets. His current role is in senior management responsible for middle market banking at a major money center bank. Mike is also a guest lecturer at the Mason School of Business. We are truly delighted to have Glenn, Niles, and Mike join us this afternoon to share their advice and expertise with the William & Mary community. Now, without further ado, I'll hand it over to Glenn.
Thanks, Elizabeth, and welcome everyone. We plan to go about an hour today, and we're going to divide that into 3 subjects, and then hopefully have enough time at the end to do some Q&A for those who have questions or observations about any of the subjects that we talk about today. So the 3 items that we're going to talk about today are 1, the economy, where we are, and more importantly, where we think we're going to be going over the course of the next several months and indeed the next year or 2. Second and related issue is the capital markets. What's happening in the equity and credit capital markets right now, and what, if anything, does history offer about where we might be going in the near future. And then lastly, we'll offer some practical advice for investors. This is a time of great uncertainty and anxiety for people with their investment accounts. And far be it for us to be offering specific advice with respect to that question, but I think there are some general notions that we can offer that I think would be useful for anyone who thinks about what their investment picture looks like for the near, intermediate, and longer term. So in terms of concepts, I'd kind of like to start with a couple of notions. And one is that cash is really the lifeblood of an economy. It moves quickly and efficiently through the system where the heart of that system is our banking system. And that works really well. It's worked well for decades, but there are times where it is in threat of not working well. And indeed, this is one of those times. And it becomes incumbent for the government through the Federal Reserve and the US Treasury to take actions as a way to create liquidity in the markets. And indeed, they are doing that. So we'll have some discussion about how effective we think these programs are and what is likely to be needed going forward. And in that context, let's think about 2 types of financial distress. And I teach a course at the Mason School where right now, Mr. Chura and I have been talking about a specific case involving corporate restructuring. But the concepts that are important there are also concepts that are useful for both the individual as well as the economy in general. And those two concepts are solvency and liquidity. So with respect to the second one first, liquidity, or illiquidity as the case may be when companies are in trouble, is simply the inability to have cash readily available to meet obligations as those obligations come due. The second issue is solvency. Solvency is when the fair value of your assets are less than the stated value of your obligations, and therefore, over the course of a longer period of time, you lack the ability to satisfy your obligations. In either case, you're in a position of financial distress. The more immediate need for us as an economy is the liquidity issue. I don't think the solvency issue is really an issue that we need to be terribly concerned about. But it is indeed the case that the longer this period goes on, more destruction there will be in terms of asset valuations. And indeed, we need to think about both solving the liquidity issue near term and over the intermediate future, getting the economy back running again where there isn't continued asset destruction. So an analogy that's being used often in the business press and on TV is that the economy has been placed in a coma. And that implies that all the systems are operating well, but you're just asleep. As soon as you wake up, everything's going to be fine. Frankly, I think that's a highly imperfect analogy. And I think the better analogy is that the economy has suffered a hemorrhage. And that hemorrhage is ongoing. And indeed, the lifeblood of the system is bleeding out. So the government's response thus far is to connect the economy with an IV, to put cash back into the system. The issue is that cash is bleeding out the other side. So until such time as you can actually close that wound, we really haven't solved the problems that are necessary to deal with the economy and move forward and get back to where we were before we had this recent interruption. So we're not going to be talking so much about the pandemic and the issues, the healthcare and public policy issues related to that, because that's not our area of expertise. We're going to be focusing more on the business and economic issues that are resulting from that, and to think about how those issues might be solved. So the two questions that are really important to think about here is, how deep is the problem and what's the duration of that problem? Because unless you can come to grips with that, you really can't then think about how you want to position yourself as an investor, or really how the government can solve these problems. So start by, where were we in February? Well, we were in a very good position in our economy. Full employment, record equity markets, very healthy credit markets, economy growing at 2% plus on an annual year-over-year basis, strong corporate earnings. Now, where are we? Well, in the last 2 weeks, we've had 10 million initial unemployment claims. The Wall Street Journal reported earlier this week that on a daily economic output basis, we are suffering a 29% fall in terms of daily economic output over where we were literally a month ago. And obviously, the equity and credit markets have moved in response to that reduced activity. And we're seeing unprecedented daily volatility. You know, the markets, as we all know, have traded down, but even the daily volatility causes us to think that indeed there is still tremendous uncertainty in the market in terms of what the future has to hold. Yesterday, there was a 1,000 intraday point swing in the market. Today, earlier, the market was up, I think, about 500 points as I looked just prior to coming on to this webinar. So the market is getting whipped around. I would say that there's two alternative camps. In fact, this is one of the rare instances that both camps may be right. There's great optimism on the part of one set of investors that we will get through this period, and they're looking indeed more longer term and ready to commit money. There's another camp that's highly uncertain in terms of the near-term prospects, and they're more defensive in nature of their posture towards their own financial well-being, and therefore they're taking a very conservative look So these swings happen day to day, and that may be a partial explanation as to which camp actually wins out on any particular day in terms of the view of the future. So that's one explanation for the extreme volatility. Let's turn back for a moment because I'd like to bring Niles into this conversation. And let's talk about just the present economic situation. What are your views on recent policy decisions, Niles? We hear a lot of talk about the types of recoveries that we might see. Is it going to be a V-shaped recovery or a U-shaped recovery or an L-shaped recovery? Let's make sure that people understand what that means and what that implies in terms of policy decisions. The Treasury is handing out literally trillions of dollars. There's a $350 billion program specifically for small businesses, with more on the way. They're already talking about another program. So how are we going to know when the all clear sign should be given? What's the role of the Federal Reserve? What's the role of the Treasury in trying to support this economy while we're in a standstill? So Niles, that's a lot for you to chew on, but I know these are things that you're thinking about, so we'd like to get your view.
Thanks, Glenn. I appreciate it. Just a little background to help provide some context for my views. At William & Mary, I studied political philosophy and economics. Then, after military and so forth, ended up in the hedge fund industry where I structured and invested in distressed debt. So my world is very micro-focused from an investment standpoint professionally, looking at individual companies in distress for whatever reason, acquire them, restructure them, and sell them off. So there's it's what they would call a target-rich environment. So I'm looking at it professionally from what are the opportunities for very specific companies. Now, that being said, my academic background and what I've been published on is macroeconomic policy and the impact of policy decisions on economic growth. What groups of decisions result in what types of subsequent economic performance. So sort of two different levels. And so one of the first things that I see is recognize what the issue is. The issue is we had a major exogenous shock to the market, a supply side shock coming out of China. Supply side is China obviously supplies supplied a lot of the goods to the world and so forth. What we have to look at is that supply side, that exogenous supply side shock, that it not work its way through the system so it becomes endogenous. In 2008, we had a problem with our capital markets, and our capital markets broke. Our capital markets are actually pretty good right now, or at least today, are in a very strong position, and Mike can talk about this some more. There isn't really much, or they're leading up to this, the banking industry or the capital markets were not the issue. That's not what caused the shock. So from a policy perspective, a lot was learned post-Great Recession. This is sort of September 2008 timeframe. A series of measures were taken or undertaken new policies. No one had really tried them before to stem the tide of illiquidity in the capital markets. Because, like it or hate it, the banks play an extremely critical role in our capitalist system. And so whether companies succeed or fail, if the money doesn't flow, then sort of all bets are off. So the lessons we learned in the fall of 2008, and I want to differentiate that, those capital markets type banking policies to keep the money flowing, I want to separate that from the later policies which were more about stimulus. And you have to actually do that today too, because the first, I think they're talking about maybe Thursday something passing, that's 3B. The first thing they did with the Fed and the actions they're taking, massive injection into the market of ultimately up to $4 trillion through leverage. But the capital markets, the Fed has immediately stepped in, taking the lessons from 08. Again, in 08, it took a while to kind of figure out what they needed to do, and they had to try some things that hadn't been tried before. So what we're seeing is, having learned some pretty good lessons, and again, Mike might have some different views, but what I'm seeing is right now, people are pretty pleased with what's been done on the monetary policy side to free up liquidity. You'll hear some things that we can talk about in a moment about, is the money actually getting to the end user and so forth. The money is there. The systems are in place. The templates are in place to do all of these things to essentially backstop the capital markets. So again, politics may say one thing or another about the capital markets and the banks and all the rest. The fact is that as of right now, at least, that is not going to be the issue going forward, so long as we continue to address things like the commercial paper market, the overnight markets that trade. One of the key, if you're interested, one of the key things you could look at is the interbank lending market. The term is LIBOR that's used. What we'll probably want to see is that LIBOR coming down a little bit, meaning that we want to see a little more activity between the banks and you'll see that in a lower LIBOR rate, showing that things aren't just good, but they can actually improve a little bit, and you can watch LIBOR for that. So on the monetary policy side, capital market side, that doesn't seem like the risk now. On the fiscal side, my personal view is the decision was made by the government, federal, state, local, to shut down about a third of the economy. I get a little bit of chuckle a little bit when I watch the news and people are clutching pearls about unemployment and all the rest. It's like, well, what did you think would happen? You just told a third of the people in the country they can't work. I don't know. It's interesting to watch where unemployment is going. Certainly you feel for the people in that position, but that's rather academic. If you tell a third of the people they can't work, a third of the people aren't going to work. So to me, what's happened is essentially what they call a government taking, if you want to look at sort of legal terms, and the fiscal programs that have been enacted so far, in my mind at least, are just rescue packages. These are not and should not be considered stimulus packages. They're essentially trying to replace income that businesses and individuals had prior to this to help sustain sort of the real economy. And that's the policy that they're trying to do. Now, there's some administrative issues why it's not as efficient as you'd like it to be. So I'm not a super expert on this, but having worked in banking, the law does not allow you just to hand out money. You have to know who you're handing out the money to. And so from a small business standpoint, there are processes that have to be followed through, and you actually want them to. It may not make good headlines, but there are these systemic risks that we already have processes in place to deal with them. So again, though, the important thing from my perspective is what we're seeing is rescue package, not stimulus. And so when we start talking about, is it going to be a V-shaped recovery, which is, hey, we found a mitigant, a therapy that works. We're going to be able to produce millions and millions of pills or whatever, and everybody can go back to work. No worry about, this is just a blip. In a quarter or two, we'll all be back to normal. No worries. I don't think that's a reality. I think we have, as an investor, this is very interesting in that how has society changed permanently? Society permanently after 2011. Society changed permanently after 2008. Society is going to change permanently now. It could end up being on the margin, but look at teleconferencing, look at telehealth. I invest in healthcare, is one of the industries that I cover. I was looking at telehealth very seriously a couple of years ago. Incredible cost savings come from telehealth that accrues to the benefit to society actually. Higher education, how much can be done online? Continuing education, homeschooling, I don't know. but it'll be interesting to see what new businesses, we'll need more delivery drivers. So from an investment perspective, it's interesting to think about where the opportunities in the sort of changing society are. But again, so we have this money coming back in. We have a look at stimulus. I don't think it's going to be a V shape. The other extent, you have an L shape, which is we've obviously dropped. We'll lose a third of our GDP. Do we just kind of stay at this low level for the foreseeable future? Back in, I'll try to stay away from politics here, but I've done a fair amount of research and publishing on macroeconomic policy. And, there's a term, secular stagnation, that you probably heard circa 2014, 15, 16. Larry Summers and others were talking about secular stagnation. Well, it's interesting, secular stagnation came about sort of around the time of the Great Depression. And most people don't realize that we actually had a recession. New Deal policies came in, and then we came into another recession. So the Great Depression was extended by multiple years, I think pretty demonstrably because of some of the New Deal policies. And so the work that I've done, there's a clear indication that when you have activist government policies and more regulation, heightened controls, government directing of investment, that you have less growth than you otherwise would. And so you had activists, we can skip a bunch of different ones, but sort of post early 30s depression, and then post 2009, you had a pretty significant increase in government activism that caused economic growth to be less than otherwise would. So my big concern here isn't that we can't recover from, a virus. It's what is the long-term damage that could potentially be done to the economy through more activist government policy. I'm a firm believer that the markets can figure it out. I mean, you had in the 20s and 30s all these discussions about, who's better. We don't sort of out of the scope of this conversation, but I firmly come down on the side of, the government needs to make certain that, the capital markets don't break, which they're doing a good job, and then to a certain extent kind of get out of the way. And again, I take stimulus and I separate that from a rescue package. I don't really have anything against rescue packages, but I do have something against some of these activist stimulus packages because they just fundamentally don't work. They look like they work, but we give up a tremendous amount on the upside because of them. And that's important as we look back, because what we're seeing now, as far as who you rescue, people are one thing, but if you look at corporates, there are a good number of corporates post-2008, the term that's used as malinvestment, post-2008, we had a huge misallocation of resources in this country. Obviously, so from 2000 to 2008, it was the housing bubble. We've had a lot of free money out there. It's been misdirected. And one of the concerns I have from a recovery is how well is the private equity, the white shoe private equity companies, how well are they positioned to do the heavy lifting turnaround? Because just if we can make things general, I would say generally speaking, they've been in the business of financial leverage and financial, the financing side of it versus the turnaround, heavy lifting, do the hard work, improving operations. That's not, so when you go sit down with the private equity guys, for the most part, the big ones, they're not focused on that kind of operational turnaround, which is what we'll need. I think that's more along the lines of, well, I mean, without naming certain firms, there are some firms mostly, and this is somewhat self-serving, I guess, but mostly in the distressed world where that's what we do. The white shoe private equity firms, it's a two-edged sword, because from a policy perspective, what I've been missing is, hey, where's the discussion about these firms sitting on tens and tens of billions of dollars to put to work today that can, do you have to rescue an airline when, let's just use the airlines for example, they got $50 billion. Well, over the last number of years, I saw they bought back $45 billion in their own stock. Well, airlines aren't going to go away, just like GM never would have gone away. They still would have produced cars. We have a bankruptcy process, So are we rescuing companies that made bad decisions in the first place, or through the misallocation of capital probably shouldn't have been in their position they were in, or are we rescuing companies because of the shock? So in the stimulus side of things, what I want to look for is, I think if we just sort of let the market cure itself from the corporate side, and let sort of the smart investors really back companies and do the heavy lifting of that turnaround, I think we'll get more of a U-shaped recovery. But if we go in and we try to use this crisis as an opportunity to centralize planning, I think we'll end up with more of an L shape.
Maybe, yeah, I think maybe that's a good place to bring Michael into the conversation, and to the extent that we have time towards the end, I'd like to come back to a couple of the things that you were talking about, and one of those is the role of government in our lives on a longer term basis as a result of this crisis, and secondly, is more in tune with our own investment decisions, where the winners and losers are in this economy coming out. Mike, turning to you, because we'd like your views as someone who's involved in the credit markets and in all the tough decisions that banks are making currently with respect to lending programs that the government has come up with to date. And indeed, it looks like those lending programs are not only going to be extended, but they're also going to be dramatically increased in size. I'm struck by an advertisement that was placed in today's Wall Street Journal, which I, on the one hand, am not surprised by because it's consistent with my own views, but I was extraordinarily surprised by the number that was placed on that. And the CEO of a company that's involved in payment processing posted an advertisement saying that the worldwide illiquidity problem for small and medium-sized businesses is $16 trillion right now, staring us in the face. The United States represents about 25% of the world economy, so just by doing simple math, and it would be precisely wrong, we have potentially a $4 trillion liquidity problem among small and medium-sized businesses in this country in terms of keeping the cash flowing through the system. So if you think about that as somehow being in the realm of what's possible, the U.S. Treasury has posted a $350 billion program, which seems quite small in the face of what could potentially be a much more sizable crisis that we're facing. So with that as good news, Mike, why don't you give us your perspective on what you were seeing on the front lines of the banking market?
Yeah, happy to do that, and appreciate everyone's time today. So I think just building off of, Glenn, your question and some of Niles' comments, I agree with Niles that what we're facing right now is very much unlike 2008, 2009. We do not have, as we sit here today, any liquidity issues as it relates to banks and the financial markets. What we do have, Glenn, to your point, is we have significant risk from an economic standpoint. Certainly, as we got to the end of the first quarter, it's absolutely going to persist in the second quarter. And I think where you start to see diverging views is what happens in third and fourth quarter of this year. And where the brunt of the pain is currently being felt are in those small and mid-sized businesses, both domestically and internationally. And it's because of the shutdown that's been enacted essentially globally, and the swiftness with which that shutdown occurred. And as we sit here today, the primary focus of the stimulus plans that have been announced particularly within the U.S. And there was the $2 trillion plan that was announced just a few weeks ago. Glenn, as you point out, $350 billion earmarked for small business. That number, based on just the headlines scrolling across the TV, will likely go up by several $100 billion over the next few weeks, because what everyone is realizing in our own hometowns, and as we watch the news and we see pictures from across the country and around the globe, is that small businesses are shuttered. And small businesses tend to have less in reserve to be able to weather this type of complete shutdown. And so the good news is that in terms of dealing with this pandemic, that the government in record time has unlocked record financing for small business. Because this has all happened so quickly and with a size and a magnitude never before seen, the process of getting the funding from the government out to those small businesses around the U.S. Is not a well-oiled machine. All we have to do is look at the news that led up to Friday of last week, when at midnight on Thursday of last week, applications were supposed to be able to be accepted at all major financial institutions. That didn't happen. Come Friday morning, there was only one major financial institution, Bank of America, that was actually accepting applications from small businesses for the Paycheck Protection Program, or PPP, and that was fraught with issues from a technology standpoint. How were they going to decide who got money, who didn't get money, as well as just the infrastructure in and around the US SBA that was not able to handle the volumes. As we moved through Friday, we saw more banks come online as it relates to being able to accept applications and then communicate with the SBA, and then able to take money and get it out to customers. And then we saw yesterday and today more and more financial institutions being able to take in applications, interact with the US SBA, and then get funds out to customers. It's clearly important in this environment to be able to get money out to those small businesses. Without question, speed matters. But to a point Niles made, banks cannot just start handing out sacks of cash to whoever shows up, because unfortunately, in this instance and in every other crisis that has ever come up, there are as many bad people trying to do bad things as there are good people trying to do good things. And so we are already seeing, and we're only not even a week into the Paycheck Protection Program, we're seeing record levels of attempted fraud. People trying to submit an application who do not actually, in fact, run a small business, do not actually need funds to pay their employees, and they're simply trying to get their hands on some portion of $350 billion. And the faster the banks run to try and get that money out, the more mistakes can get made. So fraud is a significant concern, as is things like anti-money laundering. Because let's remember, a lot of the people who get in line seeking money often are doing so on behalf of either domestic or global terrorist organizations. And so while speed is absolutely essential to get money to those small businesses that are most hurt by the shutdown from the global pandemic, it cannot be just a free-for-all.
So, Mike,
I'd
like to just ask a question, because I think what you're putting your finger on here and describing the process is absolutely essential. And that is that, as I understand it, the government has provided some umbrella protection to the banks for making these loans, so that some of the money that's going out the door is going, as you point out, to businesses that previously would be considered non-bankable. In other words, they lack the history, they lack the wherewithal, they lack the ability to do diligence on their business that would ordinarily cover off a credit process that a bank would typically go through before considering whether or not to make any loan at all. And the second issue is an important term that I'm sure a number of you listeners have heard or understand. It's called moral hazard. And that's basically in generic terms, that's where people are encouraged to do something that they typically would not do because they realize there won't be any consequences to their actions. So that's a term that's often used in the insurance business. It's used in banking. But how do you see the topic of moral hazard coming into this program and the opportunity for mischief that you're pointing out by people that otherwise would be non-bankable?
Yeah. So as I think about the risks to the stimulus program or the rescue package, as Niles correctly pointed out, it's not a stimulus package, it's a rescue package because of the complete shutdown of many small businesses. The issue we face, Glad, to your point, is not a credit issue. So we have essentially, as a financial institution, the full backing of the U.S. government from a credit perspective. So I don't stay up at night right now worrying about credit. Do not worry about that at all. And to your point, because we aren't worried about credit risk because of the backing of the U.S. government, we're able to lend to customers that we would never lend to in what I would call a business as usual environment. And keep in mind, we refer to these sometimes as loans, but within the Paycheck Protection Program, the idea behind this stimulus package by the U.S. government is that many of the participants in this program will ultimately have that loan forgiven. So think of it really more as a grant, if you will, than a loan for most borrowers. So the issue for the financial institutions is not at all credit. The issues are, first and foremost, operational risk. How do you get the applications in from millions of customers over the course of 3 months? Because keep in mind, as currently constructed, the Paycheck Protection Program opened basically on April 1st and closes on June 30th. And over that 3-month period of time, there's going to be $350 billion at a minimum moved, more likely something probably approaching $500 billion or more in 3 months for an industry that typically in the small business sector would move a fraction of that over 12 months. So think of the plumbing in your house and think about the normal volume going through the plumbing in your house, and then think about overnight putting that under the highest of high pressures and then hoping that the pipes don't burst. Well, guess what? Pipes are bursting, and it's bursting between customers and financial institutions and trying to deal with the volume of customers coming in. And then the pipes are bursting between the financial institutions and the US SBA to make sure that the SBA is approving and accepting of the given loans so that that money can then be provided to customers. So operational risk is probably risk number one. Risk number two, which gets to your moral hazard, is what I'll call financial crimes. And within the umbrella of financial crimes, I'd point to fraud, and I'd point to anti-money laundering, terrorist financing, and things of that nature. And that's where, while the clear emphasis is getting the money out to bona fide small businesses. It's a sad statement, but a true one, that there are a lot of bad people standing in line trying to get their hands on that money for illegal and immoral purposes. And that is where we're also spending as an industry a lot of time, because if we give out all the money to bad actors, there's no rescue package. We haven't rescued any small business because they haven't actually gotten the money. And so that's the challenge. That's the very real tension that is that need for speed, but also in the process making sure that the dollars are going to those businesses that actually need it, deserve it, and absolutely should get it. And so that's the balancing act every financial institution is working through right now.
Well, that's a good way to segue to the markets now. So I think your comments kind of reinforce Niles' version that this is not going to be a V shape because the plumbing in the system doesn't really provide for and can't support a V-shaped recovery. It's more likely to be a U-shaped recovery. That, to use your plumbing analogy, is going to also involve a fair amount of leakage out of the system where we're throwing money at a problem and we know a lot of that money is going to miss the target. So with that, Michael, could you cue up the slide that's U.S. stock market indices this year? Because I think that what we see here kind of hits to some of the issues that we are now talking about. So quick review here. This is year-to-date information. The markets through mid-February were actually trading very nicely. There's different indices on this table. It's the NASDAQ composite, which is the sort of medium-sized to larger tech companies. The S&P 500 is a broad index of the largest industrial companies, including financial institutions and service businesses. The Dow Jones Industrial Average, which is the one that is most often cited, is a rather imperfect index because it's a price-weighted index of 30 companies only. A lot of those are companies that, quite frankly, over the years have become less important to the economy rather than more. The Russell 2000 is an index of small companies that are publicly held, on average much smaller than the index companies that are included in any of the composites above. And then KBW Banks Index, and that's the index of stock prices of 24 financial institutions in the United States. So what is disturbing in this picture is that I think we can get a false sense where we are in the markets by looking at what the business press and the business cable news shows reports as what's going on in the markets. Because, you know, we've had a nice recovery in the last 2 weeks from what was indeed a very dire downward trend in the market. So there's been a fair amount of recovery from the depths of where we were sort of the third week of March. However, if you look at the smaller companies and indeed look at the banks who are banking those smaller companies, because the larger companies, they access the capital markets directly. They're not largely going to the banking system for money, or if they do, the banks aren't holding those monies. They're then syndicating them back into the capital markets. So the banks and the Russell 2000 are more intertwined and connected in terms of credit than is what's going on more broadly among these more popular reported indices. So if you look at the health of the underlying economy as it stands here today, I'd like, Niles, your view of what you see here, and then Mike, your view as to whether there's a message here in terms of really how bad things seem to be, because this is actually not only a reflection of where we are, but as all markets are, markets present value the expectation of all future activity as is known in the marketplace. So the story here is that I have my own views, but rather than citing my views, I'd really like Niles and Mike to jump back in. Niles, what are you thinking?
Sure. Just sort of given some time constraints, I tried to look at, like, if I were putting money to work today, what would I do? It's sort of a lesson from 2008, 2009 is you don't have to rush into anything. Now, if you're a trader, if you're a sophisticated trader, you can trade this volatility. That's not what I do. I really like the higher grade, the higher quality investment grade right now. And I mentioned that because, you know, the dislocation that we saw, and some of that's coming in right now, but some of the dislocation that we saw, those are pretty good returns. But I bring it up, you know, the single A, double A, to differentiate from triple Bs. Like I wouldn't touch triple Bs with a 10-foot pole because at the lower end of investment grade, we've had triple Bs went from 25% of the investment grade market to 48%. The lower end of the triple Bs are bigger than the double B index itself.
So when you say double B and triple B, just so people on the line are not familiar, these are credit ratings and they go from top to bottom in terms of the quality of the credit. So as you go from triple A to double A to single A to triple B, you're going down the quality spectrum. They're more risky loans and they're priced accordingly. So there's in markets like this, there's dislocations between those indices. And we can turn actually to a slide in a moment that really shows that separation. I guess, Mike, what is your quick view of the separation here as you look at the stock indices among these different sectors in the marketplace?
Well, I think what we've seen in equities is the same as what kind of Niles was referring to in the bond market, which is what I'll call a flight to quality and stability in tumultuous times. I think what's going to be interesting to see how it plays out both in the equity and the debt markets is think about the timing of where we sit today. Starting this week and really for the next 2 weeks thereafter, we're getting into earnings season. And what we're starting to see, and we would expect to see over the next couple of weeks, is companies announcing probably reasonably good first quarter results for the most case, given that, you know, COVID-19 and the pandemic really started to materially negatively impact businesses sort of mid-late first quarter. A lot of companies, in fact, I would bet most companies will cancel all guidance for 2020. So they'll take their guidance, remove that guidance. And what investors, particularly in the equity markets, are going to be focused on is not second quarter. Second quarter is going to be a washout. We're going to see terrible financial results. We're going to see historic unemployment. We're going to see a lot of very, very bad data points in the second quarter. And I think that's built into or largely built into current equity markets. I think what people are going to be focused on is what's going on with the pandemic. Are we starting to see any type of flattening of the curve? Are we seeing, both domestically and internationally, are we seeing that this rescue package funding has gotten out to those small and call them medium-sized businesses so that they can bridge the gap of the lockdown? And do we see financial institutions and sort of the larger bellwether companies out there able to continue, albeit in a distressed fashion, continue to execute their business model, and they don't necessarily have to do things like cut their dividends or do distressed financing or other things to sort of make it through, with the hope, and this is really what investors in the equity markets are banking on, it's more hope right now than fact, is that we start to see some return to normalcy, or at least sort of an upward positive trajectory and optimism as we get into third quarter. And then fourth quarter of this year returns to more of not normal, but sort of on a trajectory to normal. I think that's what the equity markets are sort of counting on. Anything that throws, you know, that flattening of the curve or the ability of smaller and medium-sized businesses to sort of bridge the gap, all of a sudden we see kind of blue chip organizations having to take drastic expense measures. Then all of a sudden that optimism sort of, gets thrown aside. And that's where, you don't see a U, but you're going to see another, fall off in the market. So everybody's really focused on that third and fourth quarter, in my opinion.
So, yeah, so the market's perspective at the moment and your comments, I think, support Niles's view that the best case is a U-shaped recovery. And within that, it seems that if the markets continue as we've seen the last couple of weeks, we're just seeing incredible daily volatility in the markets. And Niles, is a former hedge fund participant and someone who is a keen observer of the markets, can you comment briefly on the whole notion of the volatility that we're seeing in the markets and whether that is in fact due to changes over the last 10 years in terms of how investments are structured, whether it be ETFs and other forms of passive investing, the algorithmic trading of hedge funds, their leverage positions? Are there certain things that are different now than 10 or 20 years ago when we've had similar market disruptions that are causing enhanced volatility in the market?
So on the equity side, so I'm not an equity investor, but on the equity side, it's pretty easy to see that algorithms, high frequency trading, so forth, creates a lot of this versus sort of real investors. But as a special situation investor, credit investor, I have the luxury of being able to sit back and not worry about that kind of volatility. So I just I can observe it. But what I will say on the credit side is, if you buy a bond at 80 cents, you turn around the next day, get a margin call, and you got to sell it. You may not be able to sell it for 30 cents. And it's just not, and that's not an issue with today. That happened post-Great Recession. There are all these studies about liquidity. Those studies were written by people who don't understand the high yield market. That liquidity focused on treasuries and AAA or AA paper. In the high yield market, sort of the medium-sized businesses, the non-investment grade market where a lot of this volatility happens on the credit side, and where a lot of damage is done, it's because there is virtually no liquidity. And that is a direct result of policies post-2009, right or wrong. The banks essentially got out of that, a lot of the lower end of the market. And it's very difficult price discovery is extremely difficult. And so that increases the volatility. That being said, a slight mitigant is the billions and billions that went into private direct investing, private direct lending, just sort of devil's advocate to a certain extent. Part of that money went in there for two reasons. One, the banks got out of the business. And then number two, you have a lot more control of how you mark your own book. If you have a direct, you're an investment company and you make a direct loan, it's not like a broadly syndicated loan where you have 100 different investors. There's only one, maybe two investors. That is not as volatile. But what's happened is the markets, the credit markets are not, the non-investment grade credit markets are no longer, have not been for a while, very deep. And so it creates that volatility you're talking about, Glenn, which makes it very difficult if you don't have the liquidity as an investor to handle margin calls and things like that.
Right, thanks. So we're going to be bumping up against our stated time. I don't know whether we have the opportunity to extend for a little while, but just to put a finer point on, so in the long run, markets need to follow economic activity. If there's one kind of conclusion from both the credit markets as well as Niles' broad view of the economy is that it's not going to be a quick snapback. And so it's all likely that the equity markets are going to follow what is going to be a prolonged period of uncertain economic activity. It will discount the expectation of a rebound and price that into the market. But as is often the case, it takes longer for markets to recover from where the heights they were once we've hit a patch like this. There's a couple of very practical reasons for that. And that is that there's this concept of a wealth effect, and there's a virtuous cycle that takes place when markets are going up. People have more monies in their 401k plans and their investment accounts. They feel better about their careers, their livelihood, and therefore they go out and spend a portion of that money. They buy a new car, they go on a vacation, what have you. When you hit a patch like this, that wealth effect starts to go in reverse. Decisions are delayed. Sort of associated with that, consumer confidence, which is an index that's tracked on the margin. When you hit something like this, the entire population tends to go into a crouch position, and they start behaving very defensively, and that also impacts economic activity through reduced spending. And then also it's just the activity of corporate boards and executives of companies and how they think about their business plans. Business plans take a long time to produce, and therefore once you put that plan in effect, particularly in manufacturing operations, you don't want to change that plan, but circumstances force you to change those plans, but you often hesitate to change those plans until there's been some passage of time. So the reason I say that is that a lot of corporate boards and senior executives are only now, after several weeks, realizing that they need to adjust their go-forward plans for the rest of this year. So you see furloughs, you see production plans being changed, you see Tesla as a high-profile one now stopping their production lines. You see Boeing and Airbus reducing their go-forward assemblies of airplanes. The other automotive manufacturers doing temporary shutdowns. Likewise, you got companies like Exxon that are cutting way back on their capital expenditure plans. That basically echoes through the entire heavy equipment business, through the entire economy. So once these decisions to slow down manufacturing activity are put in place, it can be months and months and months before those boards and those corporate executives have the confidence to restore. So that's why there's a lag effect with a rather slow clawback to a more normal level of activity. The manufacturing cycle and those decisions are always going to follow, not lead, on the margin economic statistics. So that also argues for a U-shaped economic recovery. With that in mind, I think we're at a place now where we've only covered about 2/3 of our agenda. What we wanted to do was give some practical advice, but rather than doing that here, maybe there'll be an opportunity to do a follow-on session. But Michael, I will turn it back to you in the remaining time. If there are questions that people have that they would like Niles or I to address, our crystal balls aren't any clearer than anyone's else, but we'll give it a shot.
Well, first off, I want to say thank you, Glenn, for bringing everyone together, for bringing a great team of expertise of alumni. And I apologize, Mike did inform us that he had a hard stop at 2:30, so he had to chime off. But thank you, Mike, for joining us today. I know you're very busy and have a lot on your plate, so good luck with everything you're doing, and thanks for being a part of today. Niles, thank you as well for your part in this and perspective. I certainly think that another one down the road would be valuable, as we don't know what a lot lies ahead necessarily in the Q3 and Q4. And hopefully we'll see some good things in the weeks ahead with all the stay-at-home and everything making an impact, so we can get back to the economy that we try to help by spending more in our communities. But I want to say thank you on behalf of all of us watching now, and as well as the recording, for sharing your expertise during this challenging environment that we're trying to figure out. There are a few questions. I am happy to stay on if you and Niles, Glenn, if you and Niles are able to join us still, and others want to join, we will stay on for a little bit longer and allow for some questions, given that we have hit the 2:30 hour. I definitely don't want people, if they have meetings and so forth, to you can get the recording I'll keep the recording going till the very end of our session. But I have a little bit of time. There are a few questions coming in, and I'm sure there's more. So we may need to continue in a future episode of this if you all are open to that. But first question, some of the questions was about should the policymakers be focusing more on firms or households? And what are your thoughts around the importance of both? You talked a little bit about people's confidence and spending and so forth, and how that might be impacted.
Well, I'm sure Niles has a view. I'll give you my 2 cents worth. Well, it's a supply and demand question, right? So right now we've eliminated, by shutting down businesses, supply, and force people to, and we're giving money to people while they're not working. But at some point, there's going to be a huge supply-demand imbalance. I can sympathize with getting money to individuals because there is a significant percentage of our population that lives paycheck to paycheck, and that cycle has been disrupted. So the whole issue about liquidity, where we started this conversation, is an important one because people need cash to go to the grocery store. They need to make their next rent payment or mortgage payment. So those monies are being provided to individuals. At the same time, they need jobs to go back to. And unless we support our industries that are now shuttered, indeed, a large portion of our economy now is service-oriented. Those are very fragile institutions, the service industries. The manufacturing businesses are much better capitalized in general than is the service side of our economy. And so the Treasury's plan to try to get money to support our businesses is a noble idea. It's fraught with all kinds of complexities, as Niles and as Michael has pointed out. Niles?
Views? So I look at this, again, exogenous supply shock, that when the government made the affirmative decision to shut down the economy, it became a demand shock. To a certain extent, small businesses, you can address that with the income replacement that's being done at the individual level, if you allow the small business to get back to work. I'm in the business of having to make tough decisions, put money on the line when you don't have sometimes very little information, certainly absolutely never perfect information. And so you have to look at what you're given. I actually would come down on the side of last week and just talking to some folks, I said that in a week or so, the market's going to recognize that we probably will figure out a mitigant on the healthcare side to this. I think we're going to start seeing that. Again, if I have to, if you were to go to Vegas and make a decision. So I would err on the side of right now, if we focus on the income replacement, that in the next few weeks, if in fact there is evidence that we have something that can mitigate the health risk, meaning like if you catch this horrible virus, then you can, it doesn't necessarily have to be life-threatening. I think people will make the decision themselves to go back to work. I can see it I'm outside of New York, and I'm in New Jersey, it supposedly hit us, but you wouldn't notice it other than the streets are empty. You certainly don't hear about it other than just sort of national news, but that's a New York-centric issue that just kind of leaked out into New Jersey. But I believe that if I had to go to Vegas and put down a bet, I would bet in the next week or two, society in general, outside of New York City and maybe New Orleans, society is going to say, wait a second, risk reward, I need to get back to work. And so with the income replacement, assuming the money can get to the people, and it will at some point, that'll help the small business. And I agree with Glenn that the medium and certainly large businesses can kind of take care of themselves. I'm not worried about that. There's capital there. I would focus more on the individuals and small businesses.
So the risk is really the duration of the problem. If we can limit it, things are looking up. So another question, Michael?
Yes. What has happened to the value of the dollar during all of this, and what do you predict regarding inflation?
Huh. Wow. I don't, that's exchange rates isn't something that I really spend a lot of time on. So I don't really have a view, although I do, there's oftentimes a flight to safety when it comes to these kinds of issues. And because this is global, I think I heard that the dollar had strengthened against other currencies. But again, this is sort of outside my lane of expertise. Inflation, I think Niles is someone who spends a lot of time thinking about that. So Niles, give it your best shot.
Yeah, so real quick, US dollar, there's going to be upward pressure on the US dollar. However, that's going to be countered by everybody, including the US, to kind of push that down because you'll send the rest of the world into turmoil. So, it'll probably bounce around a range of some sort. Inflation, look, I learned a lot by studying sort of the Great Recession. What you had is you had massive liquidity being pumped into the market post-Great Recession, 2009, 10, QE 1, 2, 3, 4 through 10 or whatever it was. What was interesting and what we learned is, so there's a monetarist out of Chicago, it's sort of a quote or saying is, Milton Friedman, inflation is always something to the extent of inflation is always, about excess money. Sloshing around the system. I mean, that's not Milton Friedman's words, but that's basically it. Inflation's about too much money because inflation is just a price. And if you go back to supply and demand, and so pure inflation just means it's just dealing with the price of money. But that didn't happen, and everybody's, oh well, the monetarists were wrong. The monetary theories are all wrong. No, they weren't, because what we weren't thinking of was these extraordinary measures where the Fed and the Treasury, the government had a plan or had a very active policy to basically pump up the capital markets, but to allow very little of that money percentage-wise to ever get spent in the real economy. And so if you look at inflation, not from a monetary standpoint, but inflation from a goods and services, which is what most people look at inflation, like what's the price of eggs kind of stuff. We didn't really have it. And the reason why is all the trillions of dollars that were pumped into the market were purposely not allowed, I don't think on purpose, but because of regulations, a bunch of reasons, the money never really got into the economy. And you can see that if you start disaggregating the reserves that the banks held and so forth. This is different. This is we're actually injecting huge money directly into the real economy. Yes, it's going to the capital markets to keep it alive. So I would be looking for, especially if ends up being, not that there's a cure, but a serious mitigant to the virus. I would look for inflation this time with the knowledge that I understand we didn't see it last time, but unless the government policy becomes to try to trap that money to keep it from the real economy, which it obviously doesn't, we should in fact see goods and services inflation this time.
Yeah,
Great.
I agree with that. Yeah, Mike,
So
what else you got?
one final question, I think, for purposes of time and everything, to let you all get back to your afternoons and all those attending. And I think it's going into more of their personalized plans and where people may be individually and where retirement may be 10 years or 5 years down the road. And they've certainly done well probably over a 5 or 10 year span or 30, 40 years of investment. But recently all those gains that were back in January, February are now down to prior year's numbers. And this is more of a financial advising kind of question, but in some ways I also leave it to the question of you all and what you're doing to weather the storm as smart business professionals. What are you thinking, how to best, make sure that, everyone's different in their situation, obviously, different ages, and so forth. And it's not a simple question to answer the last question, so to speak.
Yeah.
I think for those that may be saying, do I take a little loss and be safe for the next 10 years? Do I reallocate into more just bonds or something a little bit safer, but still some growth? And do I still max out my contributions knowing that I need to have some reserves to be able to spend if need be in the immediate? And so those are all important questions that I think probably many people, not just those nearing retirement, say in 5-10 years, but those that are still needing more cash on hand in the months ahead.
Well, those are all important questions, and they certainly deserve more than a 30-second or 60-second answer. That could be the
sequel
subject of an entire, yeah, a sequel, exactly. I'll give you a couple of things to think about as a way to frame that the answer to that question without the ability to then drill down too deeply. One is that don't panic. In times of stress, people invariably make poor decisions, or most people make poor decisions, and it results in selling low and buying high, which is exactly the opposite of what you should do. Obviously, confidence was high going back 6 weeks ago. People felt good about what they were doing, so they were more likely to be buyers. Now everybody's ridden with anxiety and uncertainty, so they're more likely to be sellers. And that's a very dangerous position to be in, particularly if you watch CNBC or Fox Business News or some other, where you get all these pundits on there and none of them have ever made a wrong decision. Isn't that interesting, right? You will never get anybody on one of those shows to admit they ever did anything wrong when it came to investing. Well, if that were true, they wouldn't need to be on those shows. So don't trust. I mean, it's entertaining and sometimes it's informative, but don't try to come away with an investment strategy based upon anything you see on any of the cable news shows, CNBC, Fox Business News. There are smart people on those shows that give information that you should think about, but in terms of trading decisions, I would not use those shows. Also, you need to understand that most people involved in the securities industry are commission-based. So if they're trying to sell you something, particularly when markets are as volatile as they are right now, think twice before you act on those decisions. Your investment horizon should be a function of your age. If you're young, or even if you're not so young, but you have an investment decision horizon of greater than 5 years, say 10 years, the great thing about the US economy is that over any significant period of time, it grows and the markets follow the growth of the economy. So if you have the time, you will be bailed out. So that's what history suggests. So if you have a short duration or you have an immediate need, then and you have to make a decision, it's important to stay solvent, which again comes back right back to where we started. You need enough cash in order to get by your near-term obligations and satisfying them. But the notion of just going to cash right now because your investments aren't worth what they were worth 6 weeks ago and you're fearful, you don't act out of fear. Every investment decision should be made on the margin, given what the expectations are for the future. And I would say the future, the longer your time horizon, the brighter that future is.
Niles, any thoughts to close out before I officially?
Sure. I mean, I have two older daughters that have 401ks and whatever, and I called them and said, "Don't you dare sell anything. Just keep dollar cost averaging in." I mean, you have a long time horizon. Markets return faster than people think they do. Again, this is an exogenous shock. We'll get through this probably faster than people think we will, as long as the government doesn't screw it up. I mean, even if the government screws it up, we'll still get through it, just not as grand as we otherwise would. Again, we entered this, there was nothing, there are always issues, but we had a great economy. We'll have another great economy. If you have bills to pay, and you got to do what you got to do to feed your kids and things like that. But if you don't have to, I look at this as a great buying opportunity. These things always are. I mean, we joke about it in the hedge fund industry, especially in distress, is that if you're buying something at 70 and it drops to 20, you want to buy as much as you can. Because, if you're looking at the long term, and of course, if you're right, It's a buying opportunity, and you want the market to be as low as possible until the day you retire, and then you want it to skyrocket, right? Fundamentally believe in the economy, and to the extent that you don't need the cash today, there's no just sort of ignore a lot of the talking heads, and sort of continue to dollar cost average.
Good
Great.
advice.
Well, with that, first off, thank you both and Mike for chiming in earlier to put this together and share your expertise. As we all know, we're not able to gather in person, but we're going to keep doing a lot more virtual events for you all in the alumni community and for the William & Mary community as a whole. President Rowe's been hosting great conversations every Wednesday now, moving forward at noon. We'll be having some webinars off and on throughout different days of the week for weeks ahead. And we have the online networking hours that have been happening on Tuesdays at noon. We have a great fireside chat happening on Friday for any parents of young or teenage children. The president-elect, Dr. Lee Beard, president-elect of the American Academy of Pediatrics and a William & Mary alumna, will be doing a fireside chat with me on Friday at noon. So I hope to have some great questions from all of you attending that one. But Glenn, Niles, and Mike, thank you again for taking the time to prepare and to share your expertise. I do think that there was a lot of interest from our attendees in the live session today to do this again. So we'll have to look at the calendar and try to get something lined up in the weeks or months ahead. And be well. Check out wmalumni.com to learn more about future events. I'll send an email of the recording shortly with a survey. Please do take a moment to fill that out. That'll be helpful. And be well, everyone. Take care, and let's do our best to help flatten this curve.
Thanks, everyone. I see there's a lot of questions, and that's great. We appreciate the questions. Sorry we couldn't get to them, but maybe next time. Thanks, Michael.